The market just delivered a masterclass in human psychology disguised as price action. While everyone debates whether we're heading into a Santa rally or a year-end sell-off, they're missing the deeper lesson. This past week revealed exactly why systematic approaches consistently outperform emotional reactions. I've spent the last 15 years studying how theological anthropology, Stoic philosophy, and value investing principles create exploitable market patterns. What happened between November 29th and December 1st wasn't random market noise. It was predictable human behavior creating systematic opportunity for those disciplined enough to recognize it. Today I'm going to show you how to read market psychology like a roadmap, why the recent volatility actually strengthens the bull case for disciplined investors, and the specific framework I use to exploit crowd behavior while everyone else gets whipsawed by headlines. Let's break this down. First, let's examine what really drove this week's action through the lens of human psychology. The S&P 500 rallied 3.7% in the week, ending November 29th, with the Nasdaq surging nearly 5%. Then December 1st hit and everything reversed. The crowd celebrated this as a dovish Fed rally, followed by crypto contagion. Both narratives missed the point. This was classic mean reversion behavior dressed up as conviction. After Nvidia's brutal 13% November decline and Supermicro's 35% collapse, participants experienced relief, not genuine optimism. The 80% probability of a December rate cut became their narrative anchor, allowing them to rationalize re-entry into beaten-down names. But when Bitcoin cracked below $87,000 on December 1st, the reflexive flight from risk assets exposed how shallow that conviction really was. Here's what the crowd doesn't understand. They weren't resolving their core tension between AI valuations and future cash flows. They were simply rotating within the AI trade, seeking relative value while maintaining exposure to the secular theme. Alphabet's 14% November surge on Gemini, 3 optimism while Nvidia shed 13% perfectly illustrates this bifurcation. This isn't capitulation, it's repositioning driven by loss aversion meeting FOMO. The psychological driver is clear. Those who missed the 2023 to 2024 rally fear missing the next leg, yet those sitting on gains fear giving them back. The result is choppy, headline-driven price action with compressed time horizons. The 138-day streak above the 50-day moving average ending in November signals that the easy money phase has concluded. We're now in a regime where volatility is the cost of participation, not an anomaly. Second, let's analyze how the system processed these conflicting signals. The indices absorbed dovish Fed commentary, strong earnings data, and crypto weakness, then produced a coherent output, risk on exhaustion followed by tactical retreat. This pattern reflects positioning dynamics, not fundamental reassessment. The late November rally was mechanical, driven by short covering, systematic rebalancing into month-end, and Fed rate cut repricing after Williams and Daly signaled dovish intent. The snapback lacked organic demand. Breadth improved temporarily but remained fragile, evidenced by concentration risk. The top 10 names now command over 40% of S&P 500 weight. When these names falter, the index follows. The sector rotation into rate-sensitive areas, retail up 4%, home builders up 4%, regional banks up 3%, was rational given the Fed pivot narrative. These sectors offered asymmetric upside if cuts materialize. But the rotation lacked follow-through on December 1st, suggesting participants are testing rather than committing. The crypto sell-off acted as a real-time liquidity signal. Bitcoin's correlation with high beta tech remains intact, serving as a sentiment gauge that preceded the decline in Nvidia, AMD, and Broadcom. The system is telling us risk appetite is contracting, not expanding. The macro backdrop creates a policy paradox. The Fed's decision to end quantitative tightening while maintaining restrictive rates supports asset prices near term, but compresses forward multiples. Jobless claims at 216,000 suggest labor market resilience, and Q3 earnings growth of 13% confirms corporate adaptability. Yet liquidity conditions are easing while the cost of capital remains elevated. Technically, the S&P 500's failure to hold above 6,800 after multiple tests indicates supply is overwhelming demand at current valuations. The 50-day moving average break was structural, not a false signal. Markets that trade above moving averages for extended periods without correction tend to experience sharper drawdowns when trends break. The system is now consolidating, digesting gains, and repricing 2026 expectations. Third, here's the Stoic interpretation that creates actionable opportunity. The market is teaching the same lesson it always teaches. Price is the only truth. Everything else is narrative. November's volatility wasn't crisis. It was recalibration. The AI trade experienced its first meaningful stress test since 2023, and the structure held. Weak hands exited, strong hands rotated, and the system functioned as designed. Nvidia's 13% decline wasn't systemic failure. It was valuation correction in a name that borrowed excessively from future expectations. The Fed's dovish pivot isn't a gift. It's a response to deteriorating conditions not yet fully manifested in data. The 80% probability of a December cut reflects market pricing, not certainty. The concentration risk in the S&P 500 isn't a bug. It's a feature of winner-take-all technology dynamics. The top 10 names dominate because they generate disproportionate cash flows and possess structural moats. But concentration creates fragility. The solution isn't avoiding them. It's sizing positions appropriately and maintaining exposure to uncorrelated assets. The crypto sell-off reminds us that speculative excess always unwinds. Bitcoin's volatility isn't asset failure, it's participant failure to distinguish between price and value. Those treating it as momentum will be punished. Those treating it as a long-duration option on monetary debasement will be rewarded. Most importantly, the earnings picture provides the clearest signal. 13% blended growth despite tariffs, higher costs, and a strong dollar demonstrates corporate resilience. Margins are holding, capital allocation is improving. This is the foundation of equity returns, not Fed policy or sentiment. Now here's how to exploit this systematically. The framework I use has 3 components: behavioral pattern recognition, systematic positioning, and disciplined execution. For pattern recognition, focus on divergences between price action and underlying psychology. When the crowd celebrates dovish Fed signals while simultaneously fleeing risk assets, they're revealing internal conflict. This creates opportunity in names with strong fundamentals trading at temporary discounts. For positioning, use concentration risk as a feature, not a bug. The mega-cap tech names will continue dominating because their cash flows justify their weights, but size appropriately and maintain uncorrelated exposure. The rate-sensitive sectors showing rotation strength offer asymmetric upside if Fed cuts materialize. For execution, remember that volatility is now the cost of participation. The 138-day streak above moving averages is over. We're entering a regime where process matters more than timing. Focus on companies growing earnings at reasonable valuations, not on predicting Fed policy or crypto correlations. The path forward requires accepting that uncertainty is structural, not transient. Geopolitical tensions, fiscal imbalances, and policy uncertainty are intensifying, not resolving. The market will oscillate between risk-on and risk-off as participants react to headlines. The disciplined response is ignoring noise and focusing on signal, earnings growth, valuation, and liquidity. This is exploitable because human beings consistently mistake narrative for analysis and emotion for strategy. The system rewards those who manage risk and punish those who chase performance. The Stoic approach is preparation over prediction, adaptation over hope. The market isn't an adversary to defeat, it's a system to understand. Those who approach it with humility, discipline, and patience will compound capital. Those who approach it with arrogance, emotion, and impatience will be humbled. The choice is always the same. The outcome is always the result of process, not luck. If this framework resonates with your approach to markets, subscribe for more systematic analysis that cuts through the noise. Drop a comment sharing your biggest takeaway from this week's action. I read every response and often feature the best insights in future videos. Until next time, stay disciplined and keep exploiting the patterns others refuse to see.